In this section, we'll be talking about the theory of the chart patterns, as to why is chart pattern so important and what makes it useful for the traders to learn about, and how spotting it in the right place can be a game changer. So why is chart pattern so important and what makes it so useful for the traders to learn about? So chart patterns are basically a visual representation of what's happening in the market, and it enables us to see the price points where there's going to be a high volume of trades being placed in the market. Chart patterns are repetitive, so it lets us forecast the market in a predictable manner most times, because when we're trading using the chart patterns, we're not just placing trades without any foundation or base behind it. What makes chart patterns so useful is that thousands, if not hundreds of thousands of traders are spotting the same thing, same patterns in that security, and deciding to place the trade in the same price point. So all the volume from all the traders placing the trade there gives the price a powerful driving force toward a certain direction, which makes the probability of the trade working out much more higher. So when we see these patterns being created, a lot of other traders also sees them and recognizes them and gets ready to take the trade. So if you're trading the strategy of support and resistance or the break of them or the trendline strategy, you're basically taking the trade with a lot of other traders in the world who are seeing the same thing as you. So this enables us to better forecast the market and be the part of the pressure that all those traders are applying on that price point for the price to move in a certain direction. The part about how spotting it in the right place can be very important will be talked about later in the course when we're on the subject of the moving averages and on the combining the Trinity chapter. Now, there are hundreds of different patterns in the market, but practically we don't really need to know about all of them, as by the rules of risk management, keeping your trading plan as simple as possible is very crucial. But there are a few important patterns we do need to know about, so when we spot them in the market, we can forecast the price better, as well as we have a better foundation of confirmation for when and where to place the trades. Now, the few important patterns will be divided into two groups, one being the continuation patterns and other being the reversal patterns. But first, we'll be talking about the continuation patterns. So, number one, breakout. Breakout is a continuation pattern, but it's also a reversal pattern. It's a continuation pattern, but it can also be a reversal pattern as well. This depends on where the breakout is happening. If it's happening at the exhaustion phase of the trend towards the opposing side of the trend, then it's a reversal pattern. But if it is happening towards the direction of the trend, it's a continuation pattern. Let's look at some examples now. Chart example 1. Trend reversal breakout. So what's a reversal breakout pattern? Breakout is when the price breaks the previous high or low of the market. Like over here, you can see the market broke this low and continued in that direction. Now when millions of traders see this happening in the market, they can recognize that this is a breakout pattern and they get ready to place the trades here in this zone or wait for confirmation to place trades in this breakout zone. But some traders wait for zones to get retested, so it's another confirmation that the breakout is legit. And then at the retest, they place their trades over here, or wait for another candlestick confirmation pattern to enter there. Now let's look at the trend continuation breakout pattern. In trend continuation breakout pattern, as we know, in trendy markets, the price is not breaking out on the opposing side of the trend, but towards the trend. So if the trend is upward, like over here, it's just respecting the previous high and breaking it. It's not bouncing from this zone and creating a double top, but it's breaking outwards and creating a new high. And sometimes it retests the previous high before continuing upwards. This is called a continuation breakout pattern. Now moving on to what is a breakout and retest pattern. Break and retest patterns are very similar to the breakout patterns, as it happens only after the breakout has happened. But it doesn't happen every time there is a breakout. In break and retest, the support and resistance zones are changed. The previous support zone turns into a resistance zone if there is a retest. On the opposing trend, the previous resistance zones are turned into a support zone, like over here. Chart example 1. The price on this chart created this resistance zone here in the neckline of this pattern. But then the price disrespected this zone and broke out upwards. And after breaking out, the price came back down to the same zone and bounced outwards to the same direction it broke out towards. So when it reached this zone and bounced, it was turned into a support zone. As when the price is creating a high, it's creating a zone that we call a resistance zone. And when the price is creating a low, it's called a support. So when the price first creates a top, which is a resistance zone, and then breaks out and comes back to bounce from it, it is creating a bottom, which is a support. It's turning the resistance into a support as it is retesting the zone. This is called the break and retest chart pattern. This is another example, but the opposite of the previous chart. Over here, the price created this low, which is a support zone, and then it broke out towards the downside. So it broke the support zone, but then after a while, it came back to the previous support zone and then bounced from it. So it made a top here, which is a resistance zone, and it did it at the same price point where the support zone was created. So it turned the support zone into a resistance zone by retesting it, and then it continued to the downside. So this is the break and retest pattern, which is very similar to the breakout pattern. Now moving on to the trendline patterns. So what is a trendline pattern? As you might have heard the term, trend is your friend, and that trendy market is when you can get the best result from the market, and so on. What it means is that the value of a security is going up or down in a trendy manner, in a regular manner, and that the value of that security isn't stuck in a small price range. It's either becoming valuable and keeps on becoming valuable for some good amount of time, or the opposite when it's losing its value and keeps on doing that for some length of time. This is called a trendy or trending market. Now the trendline pattern is very similar to the trend continuation breakout pattern and break and retest pattern. Now the market's trend, like the value of something going up for some long amount of time or going down, this happens for various reasons. But while doing that, it creates some patterns which we can see on the chart and draw some zones or lines to have a better visual representation of it. Now trend line doesn't form by itself. Just like the support and resistance zone doesn't form by itself, it's something we draw on the chart so we can understand it better. So we need to look at the price and what it's doing to understand if the market is in a trendy phase or a consolidation phase. And this is where we can see that the trendline pattern is similar to the break and retest pattern, and as well as the trend continuation breakout pattern. When the market is trending, let's say it's trending on an upward direction, it's creating higher highs and higher lows, where you can see that the price is breaking the previous high of the price, and sometimes it's retesting the previous high as well. When it's breaking the previous high, it's showing the trend continuation breakout pattern, and if and when it's coming back down to retest the broken zone, it's a break and retest pattern. So when we look at the chart, we have to look for the highs and the lows and see if the highs and lows are aligned or is it forming in a different place. Now, if we look at the highs, we can look for each high and where they're forming. If the highs are forming towards an upward direction, where each high is higher than the previous high, like in this chart pattern. And then we have to look for the lows and where they're forming. If the lows are forming higher than the previous lows or not. But in this chart pattern, we can see that the highs are making new higher highs and the lows are also forming higher than the previous lows. And this signals us that the market is in an uptrend. Now let's look at the downtrending market. It's just going to be like the uptrending market, but opposite of it. We have to look for where the lows and highs are forming. Like here, we can see that the market is forming new lower lows and lower highs. This signals us that the market is in a downtrend. So now we can draw the zones and lines, which we call the trend lines. When we're drawing them in a trendy market, the trend lines are always drawn connecting the opposite side of the market trend, where we're connecting the highs or the lows that are not breaking the previous highs or the lows, but the ones that are retesting. So it's the opposite side of the trend. So for example, here on the uptrend market, we draw the lines on the opposite side of the trend. We connect the higher lows of the market because the lows are weaker, as they're not able to break the previous lows. So we're connecting the two lows and we get the upward trend line. And the next time when the market comes back to this line to create a new higher low, we can get ready for another move up. Same for the downtrend market. In this chart, as the price is trending downwards, we're connecting the highs of the market, the lower highs. As the highs are unable to break the previous high, so it's weaker in this chart. So we're connecting the lower highs and making the line. This is a downward trend line. And when the price comes back to this line, there is more chance of it bouncing from it and continuing downwards, if it doesn't break this trend line. But if it does, then it's a signal that the market might go on a consolidation phase, or the whole trend of the market can change. So this is the trend line pattern. As you can see, it's basically a support and resistance pattern, but instead drawing a horizontal line on the first high or the low of the market, it's drawn at an angle by connecting the two or three highs or the lows of the market and used as an arbitrary zone and a visual representation to show us where we can expect the price to react from. Now, trendline pattern is one of the very powerful chart patterns traded by a lot of traders worldwide. But again, in this course, we'll just be using it as a confluence to our exponential moving average course. But what makes trend lines so powerful is that it is one of the most popular strategies out there. So when the market goes into a trend, other traders sees it and they know how the price reacts when it reaches back to the trend line. They know that there is a big move coming and it's powerful, as the retest is where a lot of traders are getting in. And also when it breaks, a lot of traders are getting in as well, as they know if this trend break goes into consolidation, they won't be losing much. But if this trend break goes into forming another trend, they'll be the one getting into the market the earliest, and they'll be able to ride the whole trend, which means more profit. So the trendy market is the best phase of the market, and everyone knows that the trend is your friend. So most traders gets into positions in trending markets. But as we know that the market goes into two phases. One is where it's trending and one is where it's consolidating. We know that the market doesn't stay in the same phase forever. So if you're experiencing a consolidation phase, don't get disheartened because you're not able to take any trades right now. Because the market doesn't stay in the same phase forever. It changes from time to time. So if it's consolidating right now, wait for that to change. And in a few weeks to a few days, you will notice that the price has broken towards either of the direction, and you can get ready to look for signals for our own strategy. These were the continuation pattern, and now the following will be the reversal patterns. So the first pattern we'll be looking at is the head and shoulders pattern. There is two types of head and shoulders. One is the head and shoulder and one is the inverse head and shoulders pattern, the one that forms on the opposite side of the chart. So the head and shoulder pattern is a reversal pattern. Both the head and shoulders and the inverse head and shoulder pattern are a trend reversal pattern. It is formed after a trend or while the market is in consolidation. This signals that the market has come to an exhaustion from the move or from being in consolidation, and now there is a possibility of another trendy move. Now let's decode how and why it's formed. So let's look at the normal head and shoulders pattern first, which is formed after an uptrend most times. Here, the first peak is formed as the price went up from here, the left shoulder is formed, and then the price came back down to this level. And then the trend traders took more trades and the price went up, breaking the left shoulder's high. And then for different reasons, after the previous high was broken, there was a massive sell-off, and the price came back down to the same low as the one created at the left shoulder. Sometimes it gives a bigger wick before the formation of the right shoulder to gain more liquidity and drive the price up, but after that it still sometimes fails to create a higher high and only creates a high that is around the same level of the left shoulder. And this is where a lot of traders around the world sees the creation of the head and shoulders pattern and gets ready to take the trade, either on the right shoulder or the break of the support created when the price came back down here, or the break and retest of the neckline over here. So the same goes for the inverse head and shoulders pattern. Instead of creating a higher high, it fails to create a lower low, and the traders places their trade on the right inverse shoulder over here on the neckline. Now the second type of chart pattern we'll be talking about is the double top and double bottom chart pattern. Double top and double bottom patterns are also a reversal pattern. This is the most simple pattern, but most times it doesn't hold as much of a weight as the head and shoulder patterns and the trendline break patterns hold. Double top forms when the price creates a high and then comes back down, and then tries to create a higher high, but it fails to do that. As in this zone, many other traders are waiting to execute the trade to the opposite side of the market. So as the price is driven high to the same level here, it's met with a lot of pressure by the traders and pushed downwards, and the trend of the market changes. The best way to use double top or the double bottom pattern is to not execute the trade on the zone where you're expecting the market to reverse from, but look at the inside pattern, like this low over here, and wait for its break or the break and retest of this zone. Trendline breaks are a very powerful reversal pattern, and most times you'll see the double top or bottom or even the head and shoulders pattern being created at the exhaustion phase of the market trend. Now, trendline breaks happen when, let's say, the price is creating a higher high and higher lows, and it continues to create it for a while, but then the pressure towards the upside becomes weak, and after some time, it struggles to create a higher low, and instead it creates the same low as the previous one or a lower low, which we can see in the chart if we draw the trend lines. And this is the break of the trend line. The break of the trend line is most times followed by another big trend to the opposing side, or it goes into consolidation for a while and then it is followed by another big trend. So these were the reversal patterns. These reversal patterns will allow us to enter into the market when a new big move is starting, which is much better than entering when half the trend is exhausted. The reason we draw the lines and the zones in the chart is to make the chart patterns more visible to our eyes. So it's clearly visible and we can see the price reaching it, respecting it or disrespecting it, and then it helps us to make decisions much easier. Now, I talked about the chart patterns as it is very important to what we'll be doing here, but we're not trading the chart patterns. What I'll be teaching you in this course is how to use them as a confluence to trade our strategy, which is based on exponential moving averages. But to be able to trade that successfully, we need to understand the chart patterns and the candlestick patterns accurately.